about that sort of triangle trade-off of the attachment point, sort of the cost and the basis risk that you can take when you're designing a tail hedge? I mean, is it really customized per institution as to the, some say, hey, we really need the low cost, high convexity, so we're willing to take the basis risk. Others say, hey, we need protection at this particular attachment point to prevent any sort of future funding problems with our pension or our endowment. How's that sort of conversation work from the customization aspect?
Sure. So every client is absolutely different, but generally speaking, the key question is what's the shape of the convexity profile that a client really needs, right? It costs a lot more to have a hedge that is going to really make a material offset, say down 15 or 20, as opposed to a hedge that's going to kick in later, but really make a lot of money down 30 or down 40, right? And so that's going to be a big driver of that kind of the static cost of carry budget that somebody needs to have, and that relative to Vega mark to market. Basis risk, that conversation, usually it depends on the underlying investor. Generally speaking, doing trades that are longer dated and have more of a Vega component is going to have somewhat more basis risk than shorter dated trades. We're willing to work with people along some spectrum there. We tend to strongly discourage going out into cross asset. What about yen swap receiver swaptions to hedge equity markets? I think there are good institutions that pitch those kind of things and that show, well, look, in August 2011, you would have made X in this currency trade. But when you look at the spread of the outcomes, it's extremely wide, right? Qualitatively, like in more of a systemic, like sovereign crisis or macro crisis, those things are somewhat more likely to work. In something that's really an equity market-led event, they're much less likely to work. Like in 2018, we had a couple of pretty good market sell-offs that didn't really move cross-asset relationships at all, right? So we tend to strongly discourage in like a direct hedging mandate where what you're really trying to do is provide a certain convexity profile. You just have no idea how very off-the-run cross-asset proxy type of hedges are gonna perform in that environment. Same thing with like gold or gold vol or something like that, right? If you really have equity risk and you really want to hedge it in a reasonably precise way, you need to have optionality to what you own.